So what actually happens when an energy giant pulls in nearly $10 billion in a single quarter? Well, you get a ton of attention, for one, and you get a whole lot of investors wondering, can this energy rally really keep going? Welcome to this explainer of Shell's Q2 2026 earnings results. Today we're diving deep into the numbers behind one of Shell's most profitable quarters on record. We'll weigh that massive cash generation against the cyclical and geopolitical risks looming out there on the horizon. Let's get right into it. Here's our roadmap for today. We're going to start with the $10 billion quarter, then break down where the profits originated. After that, we'll look at rewarding shareholders and debt, shift gears into geopolitics and Q3 warnings, and finally, wrap it all up with the final investment verdict. All right, Section 1. The $10 billion quarter, a record-breaking cash machine. $17.5 billion. I really want you to burn that number into your brain. Because listen, this isn't revenue. It's not even net income. This is free cash flow. The actual hard cash left over after all operating and capital expenses are paid, generated in just a 3-month period. It's a staggering figure, and honestly, it's the engine driving this entire story. When a company churns out $17.5 billion in free cash flow, they have the ultimate financial firepower. That cash is what pays the dividends, it funds the buybacks, it slashes debt, and it covers future investments. It's pretty much the holy grail of a fundamentally healthy business. Seeing how that translates to the bottom line is wild. Back in Q2 of 2025, Shell posted a respectable $3.6 billion in net income. By Q1 of 2026, that had climbed to $5.69 billion. But then we hit Q2 2026, and they pulled in $10.82 billion. That is an explosive, roughly 200% year-over-year jump. To put that into perspective, market analysts were betting on something around $8.92 billion. Shell just absolutely blew those expectations out of the water. Moving on to Section 2, where the profits originated, beyond just pumping oil. So how exactly did they do it? Well, there are 3 massive factors driving these substantial profits: higher oil and gas prices, strong LNG trading optimization, and dramatically improved chemicals margins. This is where Shell's integrated business model really shines. A lot of folks still think of Shell as purely a company that pumps crude out of the ground, but they're a deeply integrated global energy powerhouse. This setup lets them capture value at every single step of the energy chain. If one area gets volatile, another area, like trading or chemicals, can step up and optimize those margins. And nothing illustrates that integration better than the refining and chemicals division. Check out this contrast. In Q2 of 2025, that division made just $118 million in profit. Fast forward exactly 1 year to Q2 of 2026, and that identical division raked in $2.9 billion. Literally billions of dollars more. It proves beyond a shadow of a doubt that Shell isn't entirely at the mercy of upstream crude production. When refining margins expand, they have the massive infrastructure already in place to capture that incredible upside. Okay, Section 3, rewarding shareholders and debt, where the cash goes. With all that cash coming in, they are handing a massive chunk of it straight back to investors. First up, they declared a dividend of just over 39 cents per ordinary share. That is a highly meaningful 9.4% year-over-year dividend hike, pretty much the exact kind of reliable growth income investors are constantly hunting for. But they aren't relying on dividends alone. They also rolled out a brand new $3 billion share buyback program, which they expect to finish before the Q3 results drop. Plus, they've still got $1.2 billion remaining in uncompleted buybacks from their previous program. They are aggressively shrinking the share count while simultaneously paying you more just to hold the stock. But, they're also fixing the roof while the sun is shining. $10.85 billion. That is the jaw-dropping amount of net debt Shell managed to wipe out in one single quarter. They took their total net debt from over $52 billion all the way down to under $42 billion. That drops their gearing ratio, which is a measure of their debt relative to equity, down to a very healthy 18.7%. The financial flexibility this provides is just immense. By aggressively paying down debt right now, they are practically bulletproofing their balance sheet for whenever this cycle eventually turns. Which brings us to Section 4, geopolitics and Q3 warnings, the uncontrollables. Now, we have to talk about the reality of liquefied natural gas, or LNG, right now. It is a total double-edged sword. On one hand, you've got this massive LNG opportunity. Geopolitical tensions, especially the ongoing conflict in the Middle East, have totally disrupted global supply chains. That pushes up gas prices and creates insanely lucrative trading opportunities for Shell. But on the exact same token, there is immense geopolitical risk. Those same conflicts resulted in actual physical lost volumes coming out of Qatar. It's this wild paradox where geopolitical turmoil can be highly profitable for trading desks while simultaneously being incredibly dangerous for physical assets and supply chains. And that physical risk has very real consequences. Actual oil and gas production dropped. Back in Q1, production was humming along at 2.752 million barrels of oil equivalent a day. But in Q2, that slipped down to 2.455 million. A portion of that drop was directly tied to those geopolitical disruptions and the lost Qatar volumes. It's a sobering reminder that even the biggest, most powerful companies on Earth are still totally vulnerable to global events they just can't control. Because of all this, management is playing it very carefully. Their Q3 outlook explicitly excludes potential volumes from ARC resources and completely leaves out those volatile Qatar volumes. On top of that, they're reminding the market that they still have to shell out, pun absolutely intended, a massive $24 to $26 billion in capital expenditure just to keep the whole machine running. So you can't just take that $17.5 billion in free cash flow we talked about earlier and assume it's all going into dividends. Billions in capex are mandatory just to maintain basic operations and fund future projects. So how do we summarize this massive dichotomy? Think of it like a scorecard. For cash generation and the balance sheet, both are a resounding 5 stars. Internally, the financials are bulletproof right now. But commodity risk and geopolitical risk, both of those are flashing a bright red warning sign. It's a perfect illustration of how a financially powerful, highly disciplined company still fundamentally operates in a completely unpredictable and volatile industry. All right, bringing it home with Section 5, the final investment verdict. Buy, hold, or sell. Let's break this down into a simple if-then framework to see exactly when investors might want to consider making a move. So, when is it a buy? You might consider buying on a pullback if cash flow stays strong, oil remains supportive, and debt keeps falling, but the stock price takes a temporary dip. That's when your risk-to-reward ratio improves. When is it a hold? Well, if you already own it, you hold if the debt stays controlled, the gearing is manageable, and that robust dividend remains safely covered by operations. And when do you consider a sell or reduce? You reduce exposure if oil prices completely collapse, free cash flow falls off a cliff, or if that debt starts creeping back up rapidly. 1 weak quarter isn't enough to panic, but a sustained drop in commodity prices combined with falling cash flow, that is your definitive red flag. I want to leave you with this really powerful closing thought. Shell is not a bet that oil will rise forever. It's a bet that one of the world's largest integrated energy companies can turn volatile energy markets into durable shareholder cash flow. Ultimately, you have to ask yourself, do you truly believe Shell's massive cash flow engine and their integrated model can outlast the inevitable twists and turns of global market volatility? Thank you so much for joining this explainer. Keep learning, and we'll see you next time.